Perfect. I'm glad you mentioned interest rates. So, because we saw, just so we can talk through the interest rates versus like the mortgage interest rates. So I feel like our mortgage interest rates were lower before the Fed dropped rates in September.
Yep.
Right. And then by the time everyone's like, oh, the Fed dropped rates 0.25%, then everybody's like, oh yes, now the interest rates are down.
Yeah.
And then they went up like right then. So if you could talk to, especially YouTube, if you could talk to, if we just had another, rate cut yesterday.
Yeah.
Right. And so everyone's gonna be like, oh, mortgage rates are down again. Then looking, and they're not. Or they are, but it's not necessarily like they already went down. So if you could talk about the correlation, so when people were talking about interest rates going down or the Fed cut rates, what are they talking about? What's the difference? How does it work?
Yeah. So the funny part is the low watermark for interest rates in September was September 17th, and the Fed met and cut rates for the first time in a few years by 0.5% on the 18th, and that's when rates started rising. So the Fed, and it's not what the Fed does, it's what they say. And what they said was, hey, we're going to be data dependent moving forward. We're not committing to any more rate cuts. And that's what caused interest rates to start drifting higher, because now all of a sudden there's, again, uncertainty in the market. Like, oh, shoot, I thought we were banking on, just gradual decline in rates, but I guess we can't, because now we have to wait and see what the employment reports and the inflation reports come back at, because they're not committing to anything. So rates rose a little bit, and then boom, October 4th, we get this blockbuster out of nowhere, 250,000 new jobs report, and that's rates were off to the races. And then, you get further into October and you have all of a sudden Trump starts pulling ahead in the polls, and now you're kind of shifting your trading and your forecast to, okay, well, now we got to accommodate these policies versus what we had, over here. And so rates went higher. But yeah, it's not what the Fed does, it's what they say.
Yeah, and another thing to keep in mind too with what the Fed does with rates versus mortgage rates. The way I like to think about it is what the Fed is doing. It's data dependent, but that data is looking backwards. Mortgage rates trade on what investors expect to happen. So those are forward looking versus backward looking. So even though the Fed is liking the numbers that they're seeing, inflation's looking good, they can bring rates down. Investors that are buying mortgage-backed securities are looking at what's going on in the future. So they see additional inflation risk, and even that there was also, the market is never happy. Investors are never going to be like, we're so stoked with what's going on. There was even talk after that first rate cut that, oh, it's too early for rate cuts. This is going to be inflationary, and that pushes mortgage rates up again too. So remember, when you're hearing about the Fed's rate cuts, those are backwards looking. Mortgage rates are looking forward. So there's always going to be a little bit of a disconnect between the two.